Good morning, Mr. Barnes. If you can hear me, can we uncover your camera? Thank you.
Good morning, everybody. I'm going to call the meeting to order, and without objection, the chair is authorized to declare a recess at any time. And I'd like to begin by noting some important requirements for everybody. Standing House and committee rules will continue to apply during hybrid proceedings. All members are reminded that they are expected to adhere to these rules, including decorum. House regulations require that members be visible through a video connection throughout the proceeding, so please keep your cameras on. Also, please remember to remain muted until you are recognized to minimize background noise. In the event that a member encounters technical issues that prevent them from being recognized for their questioning, I will move to the next available member of the same party, and I will recognize that member at the next appropriate time slot, provided that they have returned to the proceeding. For those members and staff physically present in the committee room today, in accordance with the attending physician's most recent guidance, masks are now optional and no longer required. With that, I'll make an opening statement. First, I'd be remiss if we didn't recognize the speech that many of us just saw in the Visitor Center by President Zelensky. We are here to talk about small businesses in the United States today, and as we do so, I just ask that we all keep in our heads and our hearts the Ukrainians who are losing not just their businesses and livelihoods, but indeed their lives. And we stand united as a committee, as a Congress, and as a country to stand tall in the face of tyranny. But to the issues at hand. Nearly 2 years ago, the rapid spread of COVID-19 was wreaking havoc on small businesses across our country. As people stayed home to slow the spread of the virus, business for many small firms essentially grounded to a halt. It was a time of tremendous uncertainty. Small businesses of all shapes and sizes began to wonder, how long could we continue to pay our rent, our employees, and make our other expenses met? Congress recognized the pandemic's threat to small businesses and the overall economy and moved very quickly and in a bipartisan fashion to pass emergency legislation. In late March of 2020, Congress passed the CARES Act on a near unanimous basis. The bill provided over $376 billion in relief for struggling small businesses. Most of this money was allocated to the newly created Paycheck Protection Program, commonly known as PPP. Under PPP, banks and other private lenders made fully guaranteed and forgivable SBA loans to small businesses impacted by COVID. These loans were intended to allow small firms to continue to pay their employees and to cover other expenses. Since it launched in April of 2020, PPP has delivered almost $800 billion in emergency loans, making it one of the most extensive relief programs in American history. The Small Business Administration administered more aid during the COVID crisis than it did for all other disasters combined in its 67-year history. Given the massive scale of PPP and other relief programs and the speed with which it needed to be stood up, it was inevitable that problems would arise. For example, in the early days of PPP, it became clear that funds were not reaching the most vulnerable small businesses. Instead, larger companies with pre-existing relationships with large banks were prioritized in many cases, and the smallest businesses' expense. The initial rollout of PPP also shut out many businesses owned by women and minorities. This committee worked diligently to address these inequities in the program throughout the pandemic. We fought for set-asides for underserved small businesses and worked to empower the community lenders that serve them. The PPP and Healthcare Enhancement Act created set-asides of PPP funds so that entities like CDFIs, CDCs, and SBA microloan intermediaries could fairly compete with big banks in the program. We also passed my bill in conjunction with Chip Roy, the PPP Flexibility Act, which made PPP loan forgiveness more accessible for firms who needed to spend a greater share of their loan proceeds on non-payroll costs. And we also passed the Economic Aid Act, which delivered more relief to the hardest-hit small businesses through second draw loans. These changes proved to be effective in making the program more accessible for small businesses. In later rounds of PPP, the average loan size reached approximately $44,000, a marked improvement over the $199,951 average loan size during the initial round. Many researchers have analyzed the effectiveness of PPP in saving jobs and reaching small businesses throughout the country. We have a few of those experts with us today. I look forward to hearing more about their research and discussing the insights they've gained into the overall efficacy of PPP and the program updates that Congress has instituted. By looking closely at these findings, we can better prepare ourselves for future crises and help SBA's non-pandemic loan programs reach more underserved businesses more effectively and more efficiently. With that, I'd like to yield to the ranking member, Ms. Van Dyne, for her opening statement.
Thank you very much, Mr. Chairman, for holding this critically important hearing and your continued partnership on providing proper oversight. In order to respond to the crushing state and local shutdown orders, the federal government stepped in with multiple relief programs. The Paycheck Protection Program was front and center during this emergency period, ensuring relief was focused on retaining employees while requiring the dollars flow to American small businesses through the private sector lenders. As we approach the second anniversary of PPP's opening, members of this subcommittee and the full committee are busy examining how this almost $800 billion program performed. And this hearing is a continuation of that discussion. As of March 6, 2020, 86% of all PPP recipients have requested loan forgiveness. In response, the SBA has made forgiveness payments of approximately $700 billion. These are extraordinary dollar amounts and show the program is winding down, but the work is not yet finished. The SBA cannot wipe its hands of this program and must stay engaged with this committee as we continue our oversight responsibilities. This sentiment also needs to be emphasized to the Department of the Treasury, who played a significant role in PPP by onboarding numerous new lenders. And as many new committee members have pointed out, Treasury Secretary Yelkin is required by law to testify before the full committee on the implementation of the COVID-19 programs, specifically the PPP. Unfortunately, 325 days past the date, the challenges small businesses face still haven't risen to the level of importance for the Secretary to appear. This cannot stand. In the State of the Union, the President stated that we're going after the criminals who stole billions in relief money meant for small businesses and millions of Americans. How can we believe that statement if appearing before our committee is too difficult a step to take? Nevertheless, my colleagues are eager to go after wrongdoers and make necessary changes, and I hope the Treasury Secretary will testify on this matter soon. This committee has a host of issues left to examine regarding PPP, including fraudulent behavior. Numerous articles and audits have highlighted trends connecting fraud to certain fintech lenders, and it's crucial we understand these lenders' role within the programs and how they interacted with small businesses, determined eligibility, and if they adequately protected American taxpayer dollars. Fraud is unacceptable, and we must address illegal behavior and ensure we recover improper dollars efficiently. Additionally, we need to learn more about how the SBA conducted PPP loan reviews. For example, if ineligible businesses entered the PPP, I'm left to wonder how they were treated under the loan forgiveness process. We must find answers to these essential questions. Moreover, any PPP conversation should include the lenders on the ground delivering this program. And that's why I'm looking forward to today's discussion with not only the Government Accountability Office, which has provided extensive oversight throughout, but also with a community bank lender who is on the front line keeping businesses in his community alive. In Text 24, our private lenders helped disperse over 40,000 loans worth well over $4 billion. And the numerous roundtables that I've held with small business owners from around North Texas, besides a tough labor market and skyrocketing energy prices, a common theme is how PPP was a lifesaver during the pandemic. And while American small businesses had been ready to grow their business without government handouts, our work in Congress is to ensure every last relief dollar was appropriately spent, and that must continue. And with that, Mr. Chairman, I look forward to our continued work on this matter, and I want to thank you for holding this hearing. I yield back.
Thank you, Ms. Van Dyne. The gentlewoman yields back. With that, I'd like to introduce our only witness on today's our best and only witness today in our first panel, Mr. William Scheer, the Director of Financial Markets and Community Investment for the U.S. Government Accountability Office. A frequent panelist representing GAO before us, he leads GAO's work in community and economic development, small business, and SBA's COVID-19 response programs. Mr. Scheer joined GAO more than 20 years ago and is a dedicated public servant. He has a master's degree in public policy and a PhD in economics, both from the University of Chicago. He also served as an adjunct faculty member in the graduate program in city and regional planning at the University of Pennsylvania. We welcome you back, Mr. Scheer, and forward you now 5 minutes for your opening statement.
Thank you. Chairman Phillips, Ranking Member Van Dyne, and members of the subcommittee. I'm pleased to be here this morning to discuss our work on SBA's Paycheck Protection Program, or PPP for short. While my statements before this committee on SBA's emergency loan programs in April 2021 and previously in October 2020 focused on program administration, controls and oversight, and fraud risk management, my statement today is about how PPP changes SBA and Congress made affected the characteristics of participating lenders and program recipients. For this work, we relied on SBA loan-level PPP data, as well as county-level business statistics and American Community Survey data from the U.S. Census Bureau. We analyzed PPP loans over 3 application periods, April 3rd through 16th, 2020, April 27th through August 8th, 2020, and January 11th through May 31st, 2021, which we refer to as phases 1, 2, and 3, respectively. Over this period, Congress provided commitment authority of about $814 billion. In summary, early lending during Phase 1 favored larger and rural businesses. Specifically, 42% of these early loans went to larger businesses, which we define as those with 10 to 499 employees. Larger businesses were more likely to have a pre-existing lending relationship with a bank. Businesses in rural areas also received a high share of these early loans relative to their representation among all small businesses. Traditionally underserved businesses, in particular, businesses owned by self-employed individuals, members of minority groups, women, and veterans, faced challenges obtaining loans, prompting Congress and SBA to make a series of changes shortly after the program launched. For example, SBA admitted about 600 new lenders, including non-banks, developed guidance helping self-employed individuals participate in the program, targeted funding to minority-owned businesses in part through community development financial institutions. Through the Paycheck Protection Program and Healthcare Enhancement Act passed in April 2020 And the Consolidated Appropriations Act passed in December of 2020, Congress established additional set-asides for businesses that applied through CDFIs and other specialized lenders. Lending to traditionally underserved businesses increased noticeably after these changes were implemented. By the time PPP closed in June 2021, lending in traditionally underserved counties was proportional to their representation in the overall small business community. While lending to businesses with fewer than 10 employees remained disproportionately low, it increased significantly over the course of the program. Chairman Phillips and Ranking Member Van Dyne, I would be happy to respond to any questions you or the panel would like to ask.
Thank you, Mr. Chair. I will begin by recognizing myself for 5 minutes. The GAO found that banks made more than 93% of the loans during Phase 1, which I recall was the first 2 weeks of the program. Did GAO determine how much of that 93% went to existing clients versus new clients of those banks?
We refer to research by others as far as the tendency to serve existing clients, but we don't have information that to answer that question as far as how much of it went to existing versus new clients.
Okay. As you're well aware, we made several changes to the program midway. Some of them included CDFI set-aside, the 14-day exclusivity period for micro businesses in the beginning of 2021, the loan calculation rule changes for Schedule C filers, and others. Of those changes and perhaps others, which of those were most effective in helping improve access, especially for underserved businesses, in your estimation, of the modifications that we made?
The modifications that I tend to focus on the most are the inclusion of CDFIs and actions taken to help smaller banks participate. Those are the two that stand out for me. So I don't want to take anything away from the other inclusion that occurred over the period, but that's what stands out the most to me.
I appreciate it. We know PPP was designed to expediently distribute funds with oversight and fraud protection occurring during the forgiveness phase. In your view, did Congress find the appropriate balance between expediency and fraud prevention? And what aspects of PPP are worth further research in that respect?
Our concern from the beginning of the program was the lack, we called it limited controls. So I'll use the words controls and oversight kind of interchangeably.
Okay.
And the lack of really what we call sound fraud risk management. So that's been a concern from the beginning. As I've said before this committee before, that we put the emergency loan programs on GAO's high risk list because of our concerns of the lack of oversight, the lack of controls in place, the lack of sound fraud risk management, and also findings from financial statement audits and just high rates, the inability to estimate improper payments. So these are all concerns of us. So it is one that is, our focus has been on SBA's administration of the program. So those are the things that stand out the most for us in terms of, we think the oversight of the program has improved over the period from the initial period. But we still have concerns with the oversight element of it. We're still concerned about the lack of comprehensive fraud risk management.
Are there any specific recommendations you might share with us in this committee relative to some of that oversight and fraud prevention that we could still yet at least call to their attention, or perhaps equally importantly, prepare for in the future?
The most progress that's been made, we made a recommendation in our first GAO-wide report in June of 2020 to really put controls in place, to really have oversight to protect the integrity of the program. So it's dealing, kind of broadly with how do you monitor borrowers to make sure they're eligible, that they're the intended beneficiaries, and things of that nature. On that, there is a master review plan that has gone through different iterations. It was recently updated, but it's largely been intact for the last, I'd say, 12 to 14 months. That is one where there's been some progress made in terms of using largely consultants in terms of automated reviews, manual reviews to oversee it. So it's like there's been improvement in that area. We're still looking for some greater movement on that. And the one area that we still are involved in discussion with SBA about is the lack of looking at what's called the self-certification for economic necessity. So we have that. On fraud risk management, we're very concerned about it because we made 2 recommendations in 2021 having to do with fraud risk management to really to do an assessment of fraud risk, to follow GAO's best practices for fraud risk management, which include naming a lead entity to do that, and of specifying what's called a fraud risk tolerance. So we've been looking, we've been calling for that, and to have an action plan to deal with the fraud issues. It was just in the last few weeks, basically, that SBA has stood up a lead entity to lead fraud risk management.
In the last few weeks.
And just in the last few weeks.
Unfortunately,
I'm sorry.
well expired.
I'm sorry
that
for
was
the long
important to get
answer,
that answered, so thank
but
you.
this is a continuing concern of ours.
Okay. Thank you, sir. With that, I yield to our ranking member, Ms. Van Dyne, for 5 minutes.
I appreciate that. And I actually want to continue exactly what you were talking about. So I feel like you felt you had to truncate that answer. I'm really concerned about the lack of fraud risk management, what you're talking about with the inability to be able to find some of these fraudulent payments. Can you give us a little bit more detail? I mean, when we say the lead entity, who is that? Are you somewhat confident that they're going to be able to actually do the job of providing that oversight?
We are at least glad that they named an entity. Basically,
Who is the entity?
it's like a fraud risk council within SBA.
Okay.
Okay, so they established a council, so there's a lead entity with the responsibility and the authority. So there's an entity that's on paper that kind of corresponds to what we would call a lead entity in charge. They're
Up
supposed
until that point, was there concern that there was just no accountability within the organization?
It was like, certainly there have been extensive looks at fraud, especially by the IG, by the PRAC, and others. There's been a look at it, but the concern is the lack of a dedicated entity and the idea that fraud risk management involves a very comprehensive and strategic approach. And what didn't happen at the beginning of the program, and really hasn't happened yet, is to really come up with an action plan. So the way I would characterize it through the oversight function, it isn't like SBA's going blind, is running blind, that they don't know, what some of the, as far as what some of the problems are with borrowers that might not be eligible. So they're not flying blind. But what we're looking for is a more comprehensive approach, a more strategic approach, a more informed approach to really to figure out the patterns of fraud risk, of fraud that's going on, and to manage that risk. We recognize in an emergency that it's logical to allow some tolerance for fraud in the program. There can be it recognizes that our fraud risk framework, that in response to an emergency.
So you're going to have to ask the question, how much fraud is acceptable? I mean, I think from
We
our position,
don't have a measure.
we would say none.
Neither does SBA, but I know the tendency is to say no fraud is acceptable. And I can say that as a principle, we don't want fraud in any program. But there is the notion that if fraud risk exists, it's just like it might be that strategically that there might be a reason to tolerate, more exposure to potential fraud
Well,
in a
part of the
program
exposure
than in a regular
Yeah.
program, considering the emergency situation. It's similar to a situation.
No,
of-
I'm sorry, but I have very limited time. I've
sorry.
got like a bunch of questions that I
Okay,
want to ask, and I
thanks.
appreciate you going on that. But looking at the potential for fraud, have you conducted any analysis on potential fraud between banks and non-bank lenders when it comes to the program? And has your research found out when it comes to oversight controls in place at the SBA, have you been able to root out that fraud? So is there a difference between banks and non-banks, and where did SBA play a role in that?
We recognize that there's certain concerns that have been raised about fintech lenders.
Correct.
Our forensic auditors have ongoing work that still is looking into the issue as far as it's largely focused on SBA's practices, but it also considers the different types of lenders. So we have ongoing work on that. One of the things I'd like to emphasize is that it'll probably be years until we know how much fraud has occurred in this program. And so what we point to an awful lot are from real-time auditing by the IG community and others, is that what we look for is how much potential fraud is out there. We observe a high level.
Do we have a number for that?
There are different numbers that have been used that we have cited from the IG and others as far as
What
how much.
potential fraud would you estimate is out there right now for this program?
I'd have to go back and
you give me a
answer it for the record. No, because it's this one, maybe a year ago when I was really discussing fraud risk, I'd be better prepared.
But you're saying those numbers are public. Your organization, GA, has
that
made them public.
we've reported multiple times.
Okay.
We have
But you
referred to
don't
the
know
IG's
what
work.
the latest numbers are at all.
No, I don't have the latest numbers in front of me.
Do you know what that would the difference between what is acceptable, what you're claiming would be acceptable compared to what we're looking at right now?
We have no standard for acceptable, but what we're saying that for SBA managing fraud risk, it's reasonable to think about how much risk are we willing to take.
I'm just wondering what the delta is, but
Yeah.
I'm out of town. Thank you very much.
The gentlelady's time has expired. Perhaps we can come to a second round, too. With that, I'm pleased to recognize the chairwoman of the Small Business Committee, the gentlelady from New York, Ms. Velasquez, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Scheer, for being here today. I am happy to see GAO validates my initial assertion that more sophisticated firms that had better access and those without pre-existing relationships couldn't get loans approved no matter how hard. First, they were not able to even have contact with those banks. And then if they did, those loans were not approved. So your report suggests that program changes made by Congress and SBA help to increase access for the intended businesses and counties. So my question to you is, would empowering CDFIs and MDIs and getting them more involved with SBA lending help address gaps in the business lending market identified during PPP?
You're asking a really good question, and it's very clear, as you said, that the changes made by the Congress and the SBA have led to greater access for especially underserved borrowers. So it's greatly improved it in this program. And I want to go back to what I said about maybe some tolerance for fraud, some as far as a strategy, is that the considerations involved in an emergency loan program, in knowing how devastating the pandemic, the effects have been on small businesses, especially the most vulnerable and the smallest small businesses that might not have access to capital. It's a different consideration when you start bringing in more lenders and targeting assistance. I think it's a more complicated story if you're talking about, let's just say, during normal times, let's just say the 7A program, as far as there's certain questions like we have followed the Office of Credit Risk Management very closely over the years. There's certain other considerations that come into effect.
And I know that our
Yeah.
first consideration must be to be safe stewards of taxpayers' money, right? The fact is, we haven't seen fraud committed by CDFIs and MDIs. So that could be another report or investigation that could be. But the report mentioned potential fraud in the COVID relief programs, and while fintech lenders were essential in helping small businesses access PPP loans, research has shown fintech-originated PPP loans are more likely to be associated with fraud. To balance the interest of safeguarding taxpayers' dollars while improving the reach of SBA lending programs, how cautiously should we proceed with non-bank lenders accessing SBA guaranteed lending?
My answer for an emergency program like PPP is that you especially have the underserved businesses that were really adversely affected, and particularly businesses owned by members of minority groups. And it might make more sense that the fintech lenders have algorithms that are, considered colorblind, things of that nature. They have served that segment of the market more heavily than some of the other lenders have. So the consideration in pandemic, I think, is different. I'll just state the consideration, I think, if you're talking about the 7A program and during normal times, is to focus on the Office of Credit Risk Management. And we've seen improvements in that program over the years. We have certainly evaluated it many times from its creation, and there have been improvements in that program. I think the focus should be on the ability of that office to oversee the new lenders.
Okay, thank you. Many view the PPP as a stress test of the small business lending market. And GAO's research and testimony from other panelists show where the gaps in the program are. So where? Do you agree that PPP was a stress test of the small business lending market and that we should be learning lessons based on where the gaps are shown to be?
There's certainly lessons learned. One is that our next enclosure on PPP in our April report will get into lessons learned for, let's just say, future emergencies.
Correct.
But there's also it casts a light on who's served by whom in a more general way. So I think it's something that we should all be mindful of.
Thank you. I yield back, Mr.
The gentlelady yields back, and I'm pleased to recognize the ranking member of the Small Business Committee, the gentleman from Missouri, Mr. Luetkemeyer, for 5 minutes.
Thank you, Mr. Chairman, and I want to follow up on your opening remarks with regards to the powerful speech and video that we saw this morning from President Zelensky. I agree that it is a very unnerving situation. This is not a video game that's going on. This is a real-life situation with people living and dying and being hurt because of war. We need to take it very seriously, and I hope the administration does just that. There was a sincere request this morning. I hope they take it sincerely and act on it accordingly. With that, thank you for bringing this topic to us this morning. Mr. Scheer, welcome again. Always enjoy your discussions with us. A lot of the things I was going to talk about have been discussed already, but I want to talk about a little bit with regards to the IG report that talked about some of the controls that they were requesting to be put in place. And as I was talking with them, and actually off the record and on the record here in committee a couple times, I asked them, well, you've identified fraud, you've identified problems within the SBA's administration of these programs, which, by the way, it's a Treasury program. It's SBA is administering it. Let's get that straight, make sure we understand that. And throughout the discussion, I kept asking the question, so you're giving them processes and protocols and new procedures. Are the leaders of SBA, are they implementing those? And the answer was yes. And so I said, well, what's the problem then? And they said, the staff's not implementing them. The staff's not living up to and operating within those procedures. Did you find that same thing? The staff didn't seem to be willing to comply with the new processes and procedures that were put in place?
We haven't seen evidence of that, but we haven't, focused that closely as far as the processes followed by the employees. But what we've focused on have been the different, automated checks, manual checks, and the like. And so that's what we focused on.
You sort of alluded to something a minute ago with respect to the reaction of SBA to your suggestions, saying that they, in essence, I don't have to put words in your mouth here, but basically you said they didn't take some of your suggestions seriously. They didn't act on them. They didn't put everything in place that you suggested. It's taking a long time for them to actually implement some of these things. So do you think they take your recommendations and IG seriously? Because it's taken until now, and you just said a minute ago that it's just 2 weeks ago they started to implement some of these things. I mean, it looks to me like we're really not taking anything seriously from the folks who could actually be helping them clean up their mess.
The things that stand out for us, and it becomes part of discussions that I and my colleagues have had with SBA, and that the Comptroller General has had with the administrator, which is the designation of the high-risk designation. And we are concerned that it's taken so long to set up an entity to manage fraud risk. It's very late in the game to be doing that. And so that stands out. And there's also concerns that just come out of the financial statement audits from the last 2 years, that there are concerns about the accounting and the internal controls pointed out by that. And those really stand out for us as something that we wish that action would have been taken more quickly in both areas.
Your statement there, sir, and I thank you for it, is that it's taken 2 years to get something done. I mean, it would appear to me, if I'm managing the agency, it may take 6 months to a year to get some new changes in place, to get people used to the new processes, but 2 years? It looks to me like they're just saying, no, thank you, we're going to work on this in our own time. Either that, or they're so overwhelmed with the process and all of the work they're having to do that they can't get to it. Is that a possibility?
You bring up a very real possibility, and one of the things that I would point out is that you do have this master review plan in place as far as oversight, but it's a little bit more of a reactive policy. They learn from what they see from the focus of that master review plan, and we're really looking for something more strategic to address these issues.
Well, I hope instead of learning from what
that's taken a long time.
Instead of learning from what they see, I hope they listen to what you say, because it would certainly be helpful to them. I've just got a couple seconds left, and I just wanted to make one more comment with regards to fintechs. I agree with Chairman Velasquez that this is a concern. It appears that that's where most of the fraud was in the PPP program. EIDL program is a whole other animal, but it does appear that from the statistics we saw, that the fintech folks were actually not very good at protecting the integrity of the program. Would you agree with that statement?
I don't think there's enough information available to draw that conclusion. So maybe we're just
you don't
cautious.
You don't have any idea that the losses were so significant compared to the banks and credit unions in this instance, because they have a know your customer rule in place that the fintechs don't, that it didn't protect the ability of the banks and those folks to do their job right versus the fintechs?
Let me just make the observation at a very simple level. We looked at lending over 3 periods of time, and there were certainly evidence of significant potential fraud in the program in all 3 phases.
But you haven't quantified it yet.
We haven't quantified it, and again, I'll go back to this.
The gentleman's time expires.
We don't know.
Mr.
We
Chair, we
don't
have to
know
wrap
how
this
much
up.
fraud. We don't know how much. We will not know for a while how much fraud has occurred in the
I
program.
think it's very important that we quantify that, and I thank you for your testimony. I thank the chairman for his indulgence. Thank you.
The gentleman's time has expired. Now I'm pleased to recognize the vice chair of the committee and the chairman of the subcommittee on contracting and infrastructure, the gentleman from Maryland, Mr. Mfume, for 5 minutes.
Thank you very much, Mr. Chairman. I want to thank you and the ranking member for convening what I consider to be a crucial hearing. Mr. Chair, thank you for being with us this morning. As we all know, if I can deliberately be redundant, the Paycheck Protection Program supported small businesses across our nation during the pandemic by allocating, as we know, $800 billion to cover payroll and operational costs. And it was such an incredible program that it lifted businesses that were in the most need and kept them afloat. So you can understand why there's so much concern here about fraud and fraud assessment and how do we not do the same thing again. I believe, however, that to truly invest in a program like this, we have to be compliant to our oversight and our fiduciary responsibilities as a committee and not only applaud the success, but to also point out failures where we see them. And the driving force behind the program was paychecks for employees. It was very simple. Yes, we care about every aspect of business and operations, but the program was designed to protect employees. So, as you might imagine, some of us have been hearing stories that just go against the grain. Mr. Chair, there's a hotel in my district, the Meriwether Lakeshore Hotel, that received a PPP loan for almost $1.1 million on April 10th of 2020. On April 15th, 5 days later, the Meriwether Lakeshore Hotel fired 100 of its employees and then closed to the public. According to PPP regulations, the hotel, correct me if I'm wrong, was required to spend 60% of its loan on payroll costs, yet it remained closed from that point during the entire period after that. And then based on information provided to me, the hotel refused later, a year later, to hire 98 of the 100 people that it had let go who had been out of work for all of that time. So I'm just trying to get some sense about this notion of give you money, take money, give you money under one claim, and then under that same claim, in this case, 100 people are let go a few days later. So could you tell me whether your research has shown whether this industry, the hotel industry, or other industries that have received cumulatively billions of dollars through this program have also failed to return workers back to jobs after receiving the money to protect the paychecks of those workers?
Our work hasn't drilled down into the very important issue that you raise. What our work has identified is the idea that this is a program out of the starting gate that relied heavily on borrower self-certifications. So I can't speak to the hotel, even though I'll mention, I live in your district in Baltimore, but I know what hotel you're
God bless
talking
you,
about.
you're a great American.
Okay, thank you. But I will say that I can't comment on the one hotel or any specific industry, but we are concerned how much the program has relied on self-certifications. And this is why we have followed so closely the oversight that's been put in place to examine whether borrowers are complying with the requirements of the program and whether the borrowers are in fact eligible for the program. So that's where our focus has been.
Well, I hope now that you have this example, based on the information that's been provided to me, that someone at GAO will look into this. I know you're not the Inspector General, but all of us are going to get instances where we have these strange kind of situations where people receive money, they fire people, and then they close down, and then the loan is ultimately forgiven, as this one was a year later. I would appreciate it if you could look into that, and if you could let myself and, of course, the committee know of your response.
Okay, I'd be glad, like as far as questions you want to put in, questions for the record. We normally don't comment on one entity, but we'll see what we can do in response to your question. So I thank you.
Thank you, and I hope you will take it as a constituent request back to you.
Okay.
Thank you, Mr. Chair.
The gentleman yields back, and now I recognize the ranking member of the Subcommittee on Economic Growth, Tax, and Capital Access, the gentleman from Pennsylvania, Mr. Muser, for 5 minutes.
Thank you, Mr. Chairman. Thanks to the ranking member. Thank you, Mr. Scheer. Before I get started, I just want to go on record quoting our Chairwoman Velasquez last year when she stated how unfortunately Treasury Secretary Yellen has declined to appear before us in complete disregard for the law, which requires her to do so. That was last May that comment was stated, and Secretary Yellen has still failed to appear. Ranking Member Lukemeyer has mentioned it many times in most meetings. It's just quite irresponsible, and it runs counter to the law. So it's kind of hard for us to, explain that, and it's not our job to explain it. I think maybe the secretary could explain it when and if she appears here. But moving along, so PPP did a tremendous amount of good. There's no question. It was a lifeline to thousands of businesses throughout my district and elsewhere. The Treasury Department at the time was very accessible. We were on the phone with then Secretary Mnuchin often, getting it going. Many of us spent countless hours, 12, 13, 14 hours a day, probably in the first 2 weeks of its inception, dealing with banks, dealing with businesses, and helping it through. So, but the bad news is the level of fraud. Now, the PPP, the numbers that I have, and I don't know, Mr. Scheer, you can, it's about $4 to $5 billion that's estimated in fraud in the PPP out of, what was the total, $840 billion, something of that nature? So, $4 billion is a lot of money, to say the least. But the problem lies in the idle. The idle has, I believe the total idle was in the neighborhood of $260 billion, and yet nearly $80 billion in fraud. Now, we all know that the PPP was done in cooperation with the SBA and local banks, primarily local community banks. The idle done straight through SBA. So clearly, the know the customer, right, KTC, is quite imperative for a program to have any integrity, right? I mean, that's almost like the simplest of answers, simplest of solutions. So I'm certainly hoping the GAO and moving forward, the SBA, that we recognize this and do what we can do to, well, no, that we do things in such partnership with the KTC ideas being followed. So I'll just ask you this, as you're working on integrity and quality and such, are you, from the GAO standpoint, is the SBA implementing for loans and forgiveness programs right now more on the quality end of things, such as in systems, or are they hiring people? What, Mr. Scheer, is being done to fortify the process as well as bring a higher level of scrutiny to the integrity of the overall system, as well as assure our forgiveness program is being done in a manner that those who deserve forgiveness are receiving? What are we investing in? How are we improving?
As I'll refer to, we've reported, in these GAO-wide reports, we've had quite a few and a lot of enclosures on the PPP program. We had a standalone report last summer, in addition to the one I'm testifying on today, having to do with controls. And so what I'll point to for PPP in particular is we also had a standalone report on SBA's use of supplemental appropriations to help support the emergency loan programs. So we know that there's heavy reliance on contractors as part of the oversight. So we know that Guidehouse is very much front and center in terms of, among other things, automated controls. We know Deloitte is very heavily involved. We know Goldschmidt is very heavily involved. And it's a mix of the automated reviews, the manual reviews, and the overall checks for kind of like the quality of that system. So that's what we observe is where there's been a oversight structure that's been in place for some period of time.
Do you agree that the system with the PPP in cooperation with community banks proved far more effective and efficient than a straight idle loan through the SBA?
With idle,
Quick answer, sir. Our
there-
time's
with
expired.
idle, with idle, there's another set of circumstances and there's another set of contractors that are involved with it. But I'll go back to just my observation that we don't really know, we won't know for a long time how much fraud has occurred in both programs. And I would want to point to the oversight
thank you,
structure.
Mr. Chair.
I would want to point to the oversight structure for both.
Thank you. The gentleman's time's expired. I'm going to give an award to the first among us who stays within his or her 5 minutes, myself included. With that, I'm pleased to recognize the chairwoman of the Subcommittee on Economic Growth, Tax, and Capital Access, the gentlelady from Kansas, Ms. Davids, for 5 minutes.
Thank you, Chairman, and to the ranking member for holding this hearing today. You know, the Paycheck Protection Program was absolutely an essential lifeline to small businesses across the country during the height of the pandemic. And small businesses in the Kansas 3rd received over 2,000 PPP loans, totaling somewhere around $820 million. And that critical funding really helped small firms in the 3rd district that I represent maintain their rent and payroll while they learned how to operate and adjust to extraordinary challenges that the pandemic presented. Unfortunately, we did see that larger banks overlooked the smallest businesses, those owned by minority or veteran and women-owned businesses while they were originating the PPP loans. And in fact, in your testimony, or maybe in response to one of the questions you mentioned, Mr. Scheer, that the community-based lenders like CDFIs were instrumental and that was a key piece of the modifications that we made. I'm curious, Mr. Scheer, what factors, from your point of view, led community-based lenders to being so much better at reaching those businesses?
No, thank you for the question. I think that you look at the missions of entities such as the CDFIs, and you can see that they have a focus on what is often called the underserved community of small businesses. So I would point to that. As far as the smaller community banks, I'd say that especially when you look at rural areas, I think that the smaller community banks really played a role. So here I'm not talking about specialized lenders per se, but I think that a lot of it is that what is the what is kind of like the mission of the various entities. With banks, you have a little bit more, and I'm not saying this to criticize banks, but you have a situation where serving your customers, it's a huge incentive to serve your customers, and that sometimes can lead to serving customers that are your existing customers that and aren't as focused on those customers, those small businesses that might be underserved.
So are we seeing, now that the PPP's closed to new applicants, but we're seeing applications coming in for the forgiveness portion of these programs, of this new program. And I'm curious if you're seeing, again, a similar kind of gap as it relates to the traditionally underserved or disadvantaged business entities.
We did some analysis around, just like we did that's in my statement today, for loans that were made, looked at the forgiveness process. And what the biggest thing that's come out of that is the very large percentage of forgiveness applications that have been approved. And so nothing, we didn't report on it. We don't plan to report on it, but I'll just state that nothing really stood out in terms of whether the forgiveness process itself was in some way could be called detrimental to any particular group.
Okay. Well, I appreciate your taking the time to testify before our committee today. And Mr. Chair, I yield back.
The gentlelady yields back, and now I recognize the gentleman from Florida, Mr. Donalds, for 5 minutes.
Thank you, Mr. Chairman. Mr. Scheer, according to the PRAC Small Business Administration Paycheck Protection Program Phase 3 Fraud Controls Report in January of 2021, the SBA OIG reported that nearly 55,000 PPP loans worth about $7 billion went to potentially ineligible businesses or fraudulent recipients. The report goes on to say that 100% of the case, in 100% of the cases the PRAC reviewed included one or more false statements on the PPP loan application that would have made the applicant ineligible. The PRAC has said that the SBA could have used IRS data to determine improper payments prior to disbursement. That opportunity to conduct pre-disbursement checks is no longer available. Have you considered the use of available commercial data like business information such as payroll, utility, or rent information to conduct reviews or audits of PPP loans?
Our forensic auditors who really take the lead and have worked with us very closely on the fraud issues certainly use what we often call data analytics and the use of different data sets, including it might be from the Postal Service, the do not pay list out of Treasury, and various other types of databases that are available to examine those issues. And certainly the PRAC and the SBA IG have been very involved in those types of examinations. At GAO, it's really our forensic audits group that we work with closely, have taken a close look and continue to take a close look at certain patterns that are present that might suggest fraud, or certainly where the flag goes up that there could be potential fraud.
All right, so looking forward, would you recommend that any future relief programs similar to PPP or other pandemic programs leverage available third-party data for verification purposes to prevent fraud, abuse, mismanagement, and also to reduce the need of costly after-the-fact remediation or enforcement?
Absolutely. And the whole role of data analytics and examining and coming up with a structure. And in this case, it would have been great to come up with a comprehensive approach using different data sources to ensure the integrity of the program, but really to ensure that the fraudsters don't get it. The shift now has been more toward, because of the passage of time, is, when I was before this committee last year, our emphasis was on preventative controls, and that's exactly what you're talking about. Preventative controls are great. Now we're in a situation, meaning the IG community, SBA, and others, where you're trying to chase down fraudsters. And that is a much more costly approach to the fraud issue than putting in preventative controls to begin with.
Thank you, Mr. Scheer. One final statement, just more for our colleagues here on the committee. When it comes to, in my view, when it comes to the role of CDFIs versus traditional commercial banks versus community banks, one of the things we have to always remember is that CDFIs have a specific mission that has been granted, frankly, by us. Commercial banks and even credit unions, they used to have a specific mission. They've obviously had mission creep in their original mission, but the community banking industry and the national commercial banking industry, and even the super regionals, one of the issues that they do face is the regulatory burden that has been unleashed on their industry by us here in Congress. And so if they have to deal with significantly higher regulatory burdens, specifically in the community banking space, which is why the community banking space has decreased substantially over the last decade in the United States. That is the reason why so many of our smaller businesses struggle with access to capital. And that is why you have new industries like fintech who are coming up to fill that space. That is in direct response to the regulatory environment that has been unleashed in banking since the passage of Dodd-Frank back in 2009. So I think it's important for the members as we look at what's happened during the pandemic and access to capital issues that we understand it is the regulatory environment that has fed industries like fintech and these other opportunities to flourish. I yield back. Under time, by the way, Mr. Chairman.
Duly recognize Mr. Donalds as Mr. Mfume also, and also Ms. Davids gets an award. Seeing no other questions, Mr. Scheer, we want to thank you for your time and your dedication to this very important work. So we now excuse you, and we will just take a few moments to set up our next panel. Thank you.
Okay, thank you very much.
All right, we want to welcome our witnesses on our second panel today. I'll take a minute to introduce each of you before your testimony. Our first witness on panel 2 is Dr. Robert Fairley, Professor of Economics at the University of California, Santa Cruz. Professor Fairley has testified before Congress numerous times on policy issues related to small businesses, and we're thrilled to have him before us again today. Professor Fairley's most recent work focuses on the third and final round of PPP, which ran during the first half of 2021 and successfully targeted program funds to underserved businesses. We look forward to hearing more about this important research and the implications it has on SBA's non-COVID business loan programs. We welcome you, Professor Fairley. Our second witness is Dr. Manju Puri. Professor Puri is the I never know how to say, Fuqua, sorry, Fuqua Professor of Finance at Duke University's Fuqua School of Business in Durham, North Carolina. She and her co-authors' research looked specifically at the intermediary supply effects of using banks as the primary delivery mechanism for PPP loans and how it contributed to the prioritization of big businesses early in the program. Professor Puri has also served as a senior advisor for the FDIC Center for Financial Research. We welcome you, Professor Puri. Our third witness is Dr. Irina Demko. Dr. Demko is a research associate at the Center for Economic Development in the Maxine Goodman Levin College of Urban Affairs at Cleveland State University, where she specializes in economic impact studies. In addition to reviewing PPP loan data, Dr. Demko and her research team also conducted a series of interviews with PPP borrowers of all sizes in Northeast Ohio. We look forward to hearing how the PPP loan data you observed tracks with the anecdotal evidence that you received. We welcome you, Dr. Demko. And now I'd like to yield to the ranking member, Ms. Van Dyne, to introduce our final witness.
Thank you, Mr. Chairman. Our next witness is Robert Barnes. Mr. Barnes is the President and Chief Executive Officer of Priority One Bank in Maggie, Mississippi. Priority One Bank is a community bank with over a dozen locations throughout Mississippi, and Mr. Barnes is testifying on behalf of the Independent Community Bankers of America, also known as ICBA. Mr. Barnes has a long history of serving Mississippi businesses and communities as he started at the bank nearly 40 years ago. During this time, he has held numerous positions and has had leadership roles. He is currently on the board of the Mississippi Bankers Association and is the chairman of ICBA's Legislative Issues Committee. Additionally, he holds membership on numerous economic, health, and education boards. Mr. Barnes also served on the governor's pandemic economic response team known as Restart Mississippi. Mr. Barnes, welcome to the committee. Your experience and background as a community banker will be invaluable as we have this conversation today. I yield back.
Thank you, Ms. Van Dyne. Professor Fairley, you are now recognized for 5 minutes for your opening statement.
Thank you. Thank you, Chair Phillips, Ranking Member Van Dyne, and members of the committee. It's an honor to testify before you on the Paycheck Protection Program. I'm a professor of economics at the University of California, Santa Cruz, and I've studied entrepreneurship, racial inequality, and small business policy for over 25 years. I've been asked to discuss the findings from my research on small businesses in the pandemic and the allocation of PPP funds to communities of color. The economic impacts of the pandemic have been especially severe for small businesses, workers, and minority communities. In my research early in the pandemic, I found that the number of active business owners in the US plummeted by 22% from February 2020 to April 2020. African-American businesses were hit the hardest, experiencing a 41% drop in business activity. Latinx business owner activity fell by 32%, and Asian business owner activity dropped by 26%. Job losses were also much higher for workers of color. Black unemployment hit a peak of 17%, and Latinx unemployment hit a peak of 18%. Anticipating these potential losses, one of the stated goals of the CARES Act was to prioritize serving underserved markets and businesses owned by socially and economically disadvantaged individuals. In the beginning of the pandemic, however, minority businesses and communities were generally delayed in obtaining financial assistance through the PPP. Research of mine and others found that the first round of the PPP went disproportionately less to minority communities. In the second round of PPP funding, fintech lenders were more involved in making loans, and disbursement to minority businesses and communities improved. A few months after the program ended in summer 2020, COVID cases began to rise rapidly and social distancing restrictions returned. Given these concerns, the PPP restarted in January 2021 with a strong emphasis on helping eligible borrowers in underserved and disadvantaged communities. A head start for applications through CDFIs, a 2-week exclusion period for applications from very small businesses were introduced. Access to loans was emphasized for sole proprietors and independent contractors that didn't have employees. From January to May 2021, 6.7 million loans totaling $278 billion were provided. But did these funds in the rebooted program get dispersed to minority communities as intended, or did the program struggle with equitable loan disbursement? So what we did is we analyzed the 12 million loans provided through all 3 rounds of the PPP. We basically have 5 main findings. First, we find evidence of a strong positive relationship between PPP loans and the minority share of the population in the 3rd round. We analyzed this relationship using several different measures and found consistent evidence that minority communities receive loans. Second, in contrast to this finding, we found a negative relationship for the 1st round in 2020 and a less positive relationship for the 2nd round in 2020. Third, we found a stronger positive relationship between minority share and loans for first draw loans than second draw loans in 2021. This is important because it might capture persistence in racial inequities from the first round, because a small business can only obtain a second draw loan if that business indeed received a first loan draw in the earlier rounds in 2020. Fourth, we found that PPP loans also went to self-employed business owners without employees in minority communities. Fifth, many more banks and financial institutions were involved in the third round, including fintechs and CDFIs, which helped spread funds to small businesses in underserved markets. To conclude then, the rebooted program in 2021 appears to have been dispersed to communities of color as intended. Although it is too early to tell what the long-term effects are from the third round of funds for small businesses in the country, there's no doubt that access to capital poses one of the most important barriers for small businesses. This is especially true for small business owners of color. Half of Black families in the US have less than $14,000 in total wealth. Half of Latinx families have less than $32,000 in total wealth, whereas the median level of wealth among white families is $187,000. Black-owned businesses also start with substantially less capital than white-owned businesses, and these disparities continue over time. I believe that two things could help us move forward. First, we need to continue to provide access to capital for struggling businesses. One method to do this is increase the range of financial institutions, both geographically and by type. Increasing involvement of a wider range of financial institutions appears to have helped improve access to loans to communities of color. Second, we need more awareness and action on increasing the diversity of suppliers and producers. Consumers often value knowing where their purchases of goods and services help disadvantaged businesses and workers, but consumers and firms need information to make these choices. Additionally, governments and businesses can increase diversity in their suppliers, all of which will help provide a steadier stream of revenues to disadvantaged small businesses. This in turn will help with the access to capital issues. Thank you for the opportunity to present the findings from my research on this topic. I look forward to hearing your comments and questions.
Thank you, Professor Fairley. And now I recognize Professor Puri for 5 minutes for your opening statement.
Subcommittee Chair Phillips, Ranking Member Van Dyne, and members of the subcommittee, thank you for inviting me to testify in front of you today. I am Manju Puri, the J.B. Fuqua Professor at the Fuqua School of Business, Duke University. I have over 25 years of research experience examining financial institutions and bank relationships. I will be drawing on my research today on PPP. When COVID hit, small businesses were particularly vulnerable. Small businesses typically have cash on hand that only lasts for a month without revenue, and in fact, less than a quarter of them can survive even 2 months without revenue. They're the engine of growth, accounting for 61 million jobs, so clearly it's important to support them and to do so quickly. So the question is, what lessons do we learn about the speedy delivery of financial support in times of crisis from PPP? Let's start with banks as the delivery channel in PPP. Now, banks seem like a natural and obvious way to distribute funds. They have large networks, they're all over the country, they're in every nook and corner. Most small businesses have accounts with banks. But does using banks as the delivery channel shape the supply of PPP? It's important to look at the funding prioritization of banks. So when PPP was originally announced, there was a scramble for funding. There were lines outside the doors of banks. The entire initial allocation of $349 billion was exhausted in a few days, by April 17th, 2020. And then after a pause of 10 days, it started again on April 27 with the second allocation of $320 billion. So looking at who gets PPP early, before April 20th, 2020, gives us a rare and clean window as to the prioritization allocation priorities of banks across clients. In particular, we distinguish between large and small banks, how they treat large and small firms, whether they treat them differently, and what is the role of bank relationships. Now, arguably, big and small banks have different business models. right? The value added by big banks is access to one-stop shopping, networks, etc., which are perhaps more relevant for large firms. On the other hand, small banks specialize in relationship-oriented lending, as suggested by the 2018 FDIC Small Business Lending Survey. I'd like to briefly give you the following findings based on 3 data sets and a very large new data set on UCC filings of bank relationships. 1, small banks deliver PPP funding more promptly. 2, if you're a firm with a bank relationship, you get PPP early. Now, this is especially true if you have a relationship with a small bank. 3, all banks in general prioritize large firms. However, the crowding out effect of small banks is fully eliminated and even reversed when firms have relationships with small banks. This suggests that the small firm, small bank relationship is special, and it should be leveraged in future and other funding initiatives. Now, a second set of lessons concerns funding hesitancy. Now, PPP funding is remarkably cheap. When it was announced, firms that took PPP saw a stock price reaction positive 1%. Yet, several firms returned PPP, and when they returned it, they again saw a positive stock price reaction, actually of 3%, 3 times. Now, why so? Our research suggests that the market values the fact that these firms return PPP, that it frees from the uncertainty of the threat of a government investigation, especially when there's uncertainty about the scope and the timing. So let me close by summarizing the key takeaway. The main point is intermediaries matter when you're delivering government funding. In PPP, funding is delivered sooner by small banks and when there are banking relationships, especially with small firms. The crowding out of small firms is less when small firms have small bank relationships. A second lesson is that there should be clear norms on ex-ante eligibility. Just as there are clear norms on ex-ante eligibility of PPP, there should also be clear guidance on ex-post investigation to help remove funding hesitancy. But perhaps the most important lesson is about intermediaries. In designing financing programs for small firms, policymakers should recognize and leverage the specialness of small bank, small firm relationships. Thank you, and I'd be happy to field any questions.
Thank you, Dr. Puri. And now I recognize Dr. Demko for 5 minutes for your opening statement.
Thank you for the invitation to testify at a hearing titled An Empirical Review of the Paycheck Protection Program. It is an honor for me to present before you and answer questions. I am a research associate at the Center for Economic Development in the Maxine Goodman Levine College of Urban Affairs at Cleveland State University. I am also from Ukraine, and my family is in Ukraine right now. I have focused my research on the access of minority, Hispanic, and female-owned businesses to PPP loans. In 2020, these businesses received smaller PPP loans than their business counterparts of the same size. For example, Hispanic-owned business with less than 4 employees received 5% smaller loans compared to non-Hispanic-owned business of the same size, or $828 less. Minority-owned business received 11% less per employee than white-owned business, or $1,000 less. Larger companies displayed increased discrepancies in loan amounts. On average, female-owned business with less than 4 employees received 17% smaller loans than male-owned business of the same size. And female-owned business with 20 to 500 employees received 22% smaller loans than male-owned business of the same size. I conducted over 20 interviews with a variety of PPP loan recipients. The sample consisted of businesses in Northeast Ohio, where nearly 40% of previously employed residents filed for unemployment as the pandemic started. I interviewed small businesses that received PPP loans from about $20,000 to over $2 million. The sample included female-owned, male-owned, minority-owned, and white-owned businesses. Every respondent expressed appreciation for the assistance provided by the government in the form of PPP loans. and the majority stated that the loan helped them retain employees. In general, businesses that received smaller loan amounts reported more difficulty with the loan application process, filing multiple loan applications with multiple banks and pursuing more unique funding sources such as fintechs. Respondents cite the reason for this difficulty stemming from the size of their business. For example, a business owner complained, "I couldn't get anyone's attention or response because I am a small business." Some respondents stated that lenders could have been incentivized to work with businesses of diverse ownership and size. Beyond the difficulty in finding a lender, many recipients of smaller PPP loans expressed frustration over loan amount limits and permitted uses. Many interview respondents didn't realize that rent, mortgage, and utility payments could be included in the requested PPP amount. As a result, they missed out on the opportunity to receive higher loan amounts. Most businesses do not have experience in doing their financial. They had a steep learning curve to understand how to apply for the loan. For us, it was all foreign language, said one PPP recipient. This highlights the importance of communication strategies and free technical assistance to guarantee the success of a public policy. From a policy perspective, if the goal is to target ethnic disparities and support inclusion in federal aid for entrepreneurs, then the program cannot be one size fits all. In 2021, SBA set aside a 2-week exclusive application periods for smaller businesses with fewer than 20 employees. While a few small businesses interviewed in Northeast Ohio did mention that exclusive application period was a valuable change, others felt that it was not long enough. Interview findings didn't confirm biases by lenders or the SBA against minority or female-owned applicants. Businesses received unequal treatment from PPP lenders not based on the demographic of their ownership, but when their business was smaller. These findings have important implications because previous literature found that minority-owned firms are substantially smaller than white-owned firms. Research comparing male and female business owners also found women operating smaller businesses in terms of annual turnover and employment size. As such, female and minority-owned businesses tend to fall under the case of businesses that may have applied for smaller PPP loans. I'm looking forward to your questions.
Thank you, Doctor. And just to say once again, all of us, this country, this committee, this Congress, have you and your family in our hearts and all of Ukraine. And we know how difficult it is to be with us today, and we're grateful that you're here. Thank you.
Thank you.
And with that, I now recognize Mr. Barnes for 5 minutes for your opening statement.
Thank you, Chairman Phillips, Ranking Member Van Dyne, and members of the subcommittee. I'm Robbie Barnes, President and CEO of Priority One Bank in McGee, Mississippi. I testify today on behalf of the Independent Community Bankers of America and want to thank you for this opportunity. Priority One Bank is a $900 million community bank with 230 employees and 15 branches in 5 counties. Our markets are rural, suburban, and urban. We are also a community development financial institution serving a predominantly low to moderate income market. The Paycheck Protection Program was a natural fit for the business model of community banks. We are small business lending specialists with local knowledge and deep roots in the communities that we serve. My bank's PPP lending is typical of most community banks. We made a total of over 1,200 loans for roughly $40 million. Our average loan amount was $32,500, and our smallest loan was for only $350. Priority One Bank's long history as an SBA 7A lender helped us to navigate sometimes challenging SBA channels on behalf of our borrowers. My written statement includes stories that illustrate the impact of the PPP. One of those stories is of a minority-owned nail salon in our community that received first and second round funding for a total of less than $12,000. Though this borrower did not initially qualify for a second round loan, we analyzed her cash flows and determined that her 40% revenue drop was pandemic related, which qualified her for additional funding. That business survived the pandemic and was able to remain open. This is just one of any number of examples I could offer. All the community banks have similar stories and results. In aggregate, community banks made nearly 60% of PPP loans, which supported nearly 50 million jobs. What's more, community banks made nearly 72% of the PPP loans, to minority-owned small businesses and 81% of PPP loans to women small businesses. I'm proud that my industry stepped up to support the survival of these diverse businesses in a time of crisis. The challenges of the program are well known to this committee. The task far exceeded the scale and technological capacity of anything the SBA had previously undertaken. However, the agency was dedicated to making the program work and continued to adapt and improve. The forgiveness phase of the program brought a separate set of challenges, but our upfront processing and strong relationships with most of our borrowers made forgiveness on the back end relatively straightforward. We did not make loans that we were not confident would qualify for forgiveness. 90% of our PPP loans have been forgiven, and we fully expect the remaining ones to be forgiven as well. We have experienced no cases of fraud or default. As you consider the lessons of the PPP in designing future SBA lending programs, I would emphasize the critical role played by community banks. SBA programs work best in partnership with experienced on-the-ground community bank lenders who are committed to the borrower's success. There's a strong network of community banks, CDFIs, and other lenders in every market in the country to meet demand for small business borrowers. SBA on its own simply does not have the resources or the know-how to effectively reach thousands of small business borrowers. What's more, community banks offer our borrowers a long-term relationship that goes well beyond the initial loan. It includes practical, real-world business counseling, mentoring, and networking opportunities. This is our core value proposition, and it is one that is especially important for startups. The SBA simply cannot replace this kind of relationship lending. Further, the involvement of banks is critical to reducing fraud. Community bankers know their customers. They know the difference between a legitimate business and a shell business set up to perpetrate fraud because they meet with business owners, visit their businesses, and see their operations. With an on-the-ground presence, SBA cannot assess borrowers firsthand. The distance from the borrower makes direct lending vulnerable to fraud. Community banks must not be sidelined in the critical task of creating access to capital. We are committed to working with this committee and the SBA to ensure the 7A program is reaching the smallest borrowers. Thank you again for convening today's hearing and for the opportunity to offer community bank perspective on the Paycheck Protection Program and other SBA programs. I'm happy to answer any questions you may have. Thank you.
Thank you, Mr. Barnes, and to all of our witnesses. We appreciate all that you've shared with us and for being with us today. I'm going to begin by recognizing myself for 5 minutes and direct my first question to you, Mr. Barnes. You just stated that Priority One Bank has experienced 0 cases of fraud in over 1,200 loans through the PPP program. So assuming that would be true for most of the banks in PPP due to their pre-existing relationships with most of their borrowers, shouldn't the government be focused more now on investigating non-bank originated PPP loans where fraud is certainly more likely to have occurred, in your estimation?
In my estimation, I think that the community banks do have an advantage, if you will, because of our relationships with our customers and existing borrowers. However, we did serve customers, or I guess non-customers, those that applied for us that were not currently customers of our bank. Mm-hmm. But as was alluded to earlier in this hearing, we have a know your customer policy that we have to abide by. And we live and we work with and we see these businesses, day in and day out. So it's very easy for us to determine legitimate businesses and from those that may not be. I can't speak for those lenders who may have made loans in communities or markets outside of where they operate and how that might have affected fraud because, as I said in my earlier opening remarks, we didn't experience any fraud. And I think that you can probably assume that most other community banks also had the same experience.
Thank you, sir. Dr. Demko, you repeatedly heard about the need for a centralized application portal to standardize the information that small firms had to submit. That would help lenders from becoming overwhelmed with processing applications, especially for smaller loan amounts. As you know, the private sector has largely abandoned this segment of the market because the fixed lending costs often outweigh the potential returns for lenders. So do you believe that these findings support the creation of a targeted direct loan product from SBA to better reach those overlooked by the banks?
I think that centralized application portal may help businesses with access to the loans. And it's not just that, it's also free technical assistance with the applications, because many of applicants didn't know what to do with the application. And I think that exclusive application period may help as well.
Any other methods that you think can be considered to better reach smaller, underserved firms?
So when we look at the distribution of minority-owned and female-owned businesses, among 1 million minority-owned businesses, 64% they employ less than 4 employees. And among 1.2 million of female-owned businesses, 65% less employ 4 or less employees. So I think that exclusive application, if we want to reach small businesses, exclusive application period may really help.
Okay, I appreciate it. And Dr. Puri, I know your findings stopped short of including CDFIs, but do you think that would be valuable to consider for other researchers, especially given their greater likelihood of having had relationships beforehand?
I think anything, what our research suggests is that relationships are important, and not just any kind of relationships. It's small firm, small bank relationships. And I think any way that you leverage this can only be helpful, right? And so, so more broadly, with its community banks or other small banks or vehicles to do it, I think that would be helpful.
Okay, I appreciate that. I'm going to yield the rest of my time and now recognize the ranking member of the committee, Ms. Van Dyne, for 5 minutes.
Thank you very much, Mr. Chairman. Mr. Barnes, before we get into the PPP discussion, I just want to ask you about the economic reality that we have on the ground today. You've got small businesses, I'm sure, are coming to you. What are they telling you about what they're facing right now with inflation, rising gas prices, the labor market? Can you just help me explain what small businesses are coming to you with today?
Certainly, Ms. Van Dyne. Businesses are still experiencing a lot of issues right now they're having to deal with. Of course, inflation being one. One of the big issues that we're experiencing in the markets that we serve is the fact that is getting employees back to work. They're just at this point in time, they're still understaffed, still looking for qualified employees to come back in and help their business. Inflation has not helped at all, of course, and that puts a tax on the small businesses. It's not a governmental tax, but it's certainly a tax that they're still having to absorb. So small businesses are still struggling out there. And of course, we're relationship lenders, as all community banks are. We work with our customers extremely closely. Our borrowers, we communicate with on a regular basis, and we stay in close touch with them. And it's a difficult time. COVID has knocked our businesses back down 2 or 3 times. When you think you get up, all of a sudden another wave comes and you're knocked back down. But hopefully we're toward the end of this and we'll see some improvement as we move forward.
I appreciate that answer. And I agree with your statements on direct lending. From a fraud and efficiency perspective, private sector lenders have consistently outperformed. I think you've heard that from all of our witnesses here today, while also safeguarding taxpayer dollars. But from your perspective, what does history tell us about the government getting involved in direct lending? And at the end of the day, do these programs better assist small businesses as compared to the private sector-driven 7A loan program?
Based on my experience, and I've been a lender for a number of years and have been an SBA lender and done a number of 7A loans as well as 504 loans. And I think the partnership between banks and SBA is a good partnership. The government getting involved in direct lending, I think, has proven that it does not work. Borrowers in general don't have a high level of trust, to be honest with you, in dealing directly with a governmental entity. I don't think they're going to be able to reach those borrowers. It is a complex process to go through when you're dealing with SBA. It's just the facts of the matter. We as bankers understand that. We learned the process. We can navigate that and help our customers be able to obtain the funding that they need through that process. But from a direct lending standpoint, I'm afraid you're going to alienate a lot of customers that may otherwise be able to be served through a banking relationship and a guaranteed loan process by going with the direct lending.
And thank you for that. You know, I also appreciate you talking about just kind of the excessive regulations that we see being faced by a lot of the small businesses today. We're trying to get a bill passed that would actually address exactly that. So when it comes to access to capital, I believe there should be always have a conversation on how these regulations are affecting small lenders. So, for example, we see that the CFPB is in the process of promulgating rules for Section 1071. Can you share the community bank's perspective on this rulemaking?
Certainly, I'll be more than happy to. Rule 1071, as you know, was mandated under the Dodd-Frank Act, and is something CFB has no option but to implement. However, as currently presented and proposed, the rule goes beyond what is mandated in Dodd-Frank as far as collection of data. And basically what the rule is a hum to tight rule for small business lending. But what's being required right now or presented or proposed by the CFPB, going beyond those requirements, is going to expose, I think, our borrowers to potential concerns about their right to financial privacy. It's going to put information out available to the public that's going to be information that could be detrimental to them from a competitive standpoint. And our borrowers are hugely concerned about that. We've been hearing from a number of them about this, and we don't have a choice but to comply with it, obviously. But I think that it could force some of these borrowers to seek other options as opposed to the banking system because of the fact that they're concerned about the information that's going to be collected and their invasion of privacy.
I appreciate your testimony here today. I think it's something that we really need to look at and make sure that we're advising, because SBA's job is really to be able to support and advocate for small businesses. And if we are adding additional regulations and additional hurdles to you being able to move on in your business, I think that's doing a detriment and the exact opposite of what we should be doing. So thank you very much for your testimony here today and all the witnesses, and I yield back.
Seeing no other members asking questions, we're going to do one more quick round. I have one question for Dr. Fairley. And Doctor, I recall that you came here last year and provided testimony, and I want to welcome you back to the Small Business Committee. Perhaps you could just take a moment and share how your current report builds off of last year's.
Yeah, so previously I reported on what was happening to small business owners. So some of the numbers that I briefly mentioned, one of the most troubling was the 41% drop in Black business owner activity. And so I've been studying the pandemic and studying small businesses over the pandemic, and that kind of evolved over time into really being interested in what was happening with the policy solutions, so the PPP program. And so since then, I've been studying what has happened over those 3 rounds, seeing that kind of first round and studying it carefully and seeing that a lot of minority communities were not receiving those funds, and then going to the most recent study in the 2021 program and seeing that it made a big difference. There was a huge shift in terms of what we found in terms of that relationship with minority communities. So it was kind of a positive sign that the changes in the program really made so much of a difference.
Thank you, sir. Mr. Barnes, your testimony mentions ICBA's support for SBA's 504 program, which, as you know, is experiencing significantly increased demand that caused a brief lending pause at the end of the last fiscal year. So how disruptive is it for a vital lending program like that to be under the annual threat of a shutdown due to increased demand?
In my experience, it's hugely disruptive. And I want to thank Congress for continuing that program and providing additional funding to allow it to continue. I have actually been in situations personally where I was the lender of a 504 loan, and the funds ran out before the 504 loan got funded. And we had to wait, the customer had to wait on their business loan for almost 4 months before they could get any funding for it. You can imagine that 4 months, if they had been operational, they would have been employing people, obviously generating income, and paying taxes on that income, and it would have been a commerce and for the communities that were served. But it's hugely disruptive when you've got a deadline you're coming up against. You've got a finite amount of funds that you can draw from, and there are more than enough of borrowers out there looking for those funds. So thank you again for the additional funding and additional time.
Yeah, just to follow up on that, sir, unlike the 7A program, 504 still lacks a provision that allows SBA to adjust the funding level without needing congressional approval. So without such a provision, the program is under constant threat of a shutdown if the pace of lending exceeds the expected levels. So in your estimation, sir, should the 504 also have what we might call a shock-absorbing mechanism as 7A?
In my opinion, I think that would be a great idea. Like I said, it would allow us to be able to serve borrowers when they need to be served and not have a disruption to their business model going forward.
Thank you, sir. I'm going to yield back the remainder of my time and recognize the ranking member, Ms. Van Dyne, for 5 minutes.
Thank you. I just have one quick question, Mr. Barnes. You stated that we did not make loans that we were not confident would qualify for forgiveness because we did not want to saddle anyone with unintended debt. And this struck me as significantly important in contrast with perhaps how some of the other non-relationship lenders might have treated customers. So can you talk to the committee a little bit more about this statement and how you operated under this program?
Certainly, I'll be happy to. In every case, when a borrower came to us for a PPP loan, we walked them through the process. We asked them for information to basically be convinced that they were eligible for the PPP loan and also that it would stand up through the forgiveness application. We, and many times, worked with their accountant or financial advisor that they may have been working with through their business to gather information. So we wanted to make absolutely sure that we didn't put a customer in a situation that we were trying to help and all of a sudden we've made it worse because they have now another loan that they have to pay. And they were already struggling to pay the initial loan maybe that they have on their business. So I think it's just relationship banking. I mean, that's what we do every day. We have a relationship with that customer. We work with them. We try to make sure that we improve their situation. We don't harm them by putting them in a worse situation. And our lenders are understand that. They're very good at that. We had lenders here that worked 24 hours a day, 7 days a week, trying to kind of build an airplane while we were in flight to get this program up and going and started. And it was very, very frustrating. But I think in the end, our main objective was to help as many customers and as many businesses in the communities that we serve as we possibly could.
I think you just proved again that there is no, there's no questioning that people on the ground who know their community, who are working in the community with actual real people, completely outweigh the DC bureaucrats in being able to be efficient and effective in helping the community. So thank you very much for your testimony today. I yield back.
The gentlelady yields back. And with that, I want to thank all of our witnesses again for joining us today. Your research analyzing PPP is a vital tool for all of us on this committee as we work to make SBA programs reach the smallest of small businesses throughout the country. And it's heartening to see that the changes Congress did institute had a profound effect on entrepreneurs that were initially shut out of PPP. It's also vital that we take the lessons learned from the PPP program and apply them to current and future SBA programs. Making these programs more accessible and equitable will ensure that more entrepreneurs can pursue their dreams and that all small businesses have a chance not just to survive, but to thrive. I also want to note that the passage and implementation of PPP was an acknowledgement of Congress's responsibility to help small businesses during the COVID-19 pandemic. For the hardest hit small businesses in disproportionately impacted industries, including restaurants, live events, and fitness, the fight is still far from over. We have to once again acknowledge our responsibility to maintaining the strength of our small business ecosystem, and I would argue pass additional targeted relief to ensure that our nation's most resilient small businesses do not close their doors after surviving 2 years of this terrible pandemic. I urge the inclusion of such relief in any supplemental COVID-19 bill that comes before this Congress. With that, and without objection, members have 5 legislative days to submit statements and supporting materials for the record. And if there are no further business to come before the committee, without objection, we are now adjourned. Thank you, everybody. Thanks.
Thank you.